This is Nightly Business Report with Tyler Matheson and Sue Herrera.
What Monday blues? Stocks kick off the week in rally mode, but after going nowhere for a year, are new highs within reach.
Global glut, China's oil industry, once strategic, is now struggling. Tonight, rare access to that nation's oil fields.
You're hired, what some employers really think of your online degree. All that and more tonight on a special edition of Nightly Business Report from Chicago for Monday, May 16th.
Good evening, everyone, and welcome. We are broadcasting tonight from the heart of Chicago, thanks to our friends here at the studios of WTTW. Our big story tonight is the rally on Wall Street, and it was driven by two very familiar factors: oil, which has been a touch point for the market, and Apple, one of the most widely held stocks by individual investors and institutions. That combination lifted the Dow Jones Industrial Average 175 points. It closed at 17,710. NASDAQ added 57, and the S&P 500 gained 20. Let's focus first, though, on oil prices, which rose to 2016 highs because of some production outages globally and because of an upbeat forecast from Goldman Sachs, one of the most active banks in commodities. Jackie DeAngelis has more.
Today, a new oil order called for by Goldman Sachs. Are the bears on Wall Street starting to get bullish? Well, Goldman today changing its second half price target for crude to $50 a barrel, citing output disruptions in Nigeria and better than expected demand. Goldman was one of the biggest bears on the street, at one point calling for $20 oil. We didn't see $20 exactly, but earlier this year in February, we did go close to $26 on oversupply concerns. But Goldman cautions that prices could move lower, back to $45 in early 2017, as it sees higher production out of Iran and Iraq, bringing global inventories back up. And seasonal trends show that demand drops in the first quarter. Estimates on current global supply disruptions are a little less than 4 million barrels per day. While OPEC pumped more in March, its highest output since 2008, production in the U.S. is steadily dropping. But other factors are impacting oil as well, perhaps maybe more persuasive than what Goldman Sachs is suggesting.
Gasoline demand is running about 800,000 barrels a day over last year at this time, a really significant amount. In fact, is a record at this point. The weak dollar has supported prices. We have lost some production in the U.S. and in Venezuela, but OPEC keeps producing at record levels, so that's kind of offsetting that at this point.
But buyer beware. Last year in June, prices went to about $60 before they dropped to about $40 in August when summer demand dropped off. If history repeats itself, we could see that pattern again this year. For Nightly Business Report, I'm Jackie DeAngelis.
Despite the rise in oil prices today, the prolonged downturn took yet another victim. Sandridge Energy filed for Chapter 11 bankruptcy protection after securing support for its debt-cutting plan from its creditors. Sandridge says it can continue operations while improving its balance sheet and will now focus on oil and gas production in Oklahoma and Colorado.
Well, that prolonged drop in crude prices has taken a toll on the oil industry in China, which, as you probably know, is the world's second largest oil consumer. And in an unusual move, some production in China is quietly being shut down. Eunice Yoon obtained rare access to China's oil fields and reports tonight from Dongying.
Few outside China's state-dominated oil industry get a chance to see this. Shengli oil field is the second largest in the country, and developing it has been a national priority for this energy-hungry economy.
The first oil well was drilled here in Shengli in 1961. The industry was seen as strategic, so as part of a state directive, the government expanded the oil fields.
But now China's oil industry is a victim of the global supply glut. In January, offshore producer CNOOC said output would drop by the most since 1999. PetroChina says its production in 2016 is expected to fall for the first time in 17 years. And Sinopec said it's already closed 4 sites at this field, as competitors like Saudi Arabia refuse to reduce output, suppressing prices and squeezing high-cost producers like Beijing. Here, pump jacks, or nodding machines as they're called in China, hang their heads in silence.
Each of these oil wells produces about 10 barrels of oil a day. The workers here tell us that the process isn't very efficient. When the price of oil was high, though, the company still made a lot of money. But now, that is no longer the case.
The workers say production has been cut by at least 10%. Many complain about shorter working hours, lower pay, no bonuses or raises. Zhang, a 20-year industry veteran, earns $615 a month. Many of us don't want to work here anymore. Some have already left the oil field and started small businesses, he says. The salary here is low, while the prices of goods continue to rise. Contract workers like Xing tell us assignments are few and far between. It's not easy to find work nowadays. It's even harder to stay at a long-term job, he says. Migrant workers are just like donkeys. If a donkey can carry a heavy load, it gets fed. If not, no food. Yet having a secure energy supply is a matter of national security for China, the world's second largest oil consumer. Though less and less is coming from homegrown producers as long as oil prices stay so low. For Nightly Business Report, I'm Eunice Yoon in Dongying.
Now to Apple, the stock easily the best performing today on the blue chip Dow index after Warren Buffett's Berkshire Hathaway disclosed that it purchased more than 9.5 million shares of the company during the first quarter. According to regulatory filings, this marks Berkshire's first investment in Apple. The decision to buy Apple was not made by Buffett himself, but instead by one of his two deputies. Apple shares reacted by moving more than 3.5% higher, its best day since March.
Well, the Berkshire Hathaway stake in Apple comes as Apple's CEO Tim Cook began a tour of China. That's the second biggest market for the company. Cook visited one of Apple's main stores in downtown Beijing. He was accompanied by the president of China's popular ride-hailing company, which Apple invested $1 billion in just last week. Apple's business has come under pressure in China recently because of the slowing of the economy, increased competition, and a government clampdown on some of its services, including iTunes and iBooks.
Fellow Dow component Pfizer is making a $5 billion acquisition. The drug company is buying Anacor Pharmaceuticals, which makes an eczema gel. The deal comes just 1 month after Pfizer scrapped plans to acquire Allergan for $160 billion. And some say today's deal represents a shift in strategy, one that now focuses on strengthening its pipeline of drugs ahead of a possible decision to sell or spin off its generic medicines business. Shares of Anacor soared 57% today. Pfizer shares rose fractionally.
The Dow component Verizon and striking union officials will restart labor negotiations tomorrow, this after meeting with Labor Secretary Tom Perez over the weekend. Nearly 40,000 workers walked off the job last month. The grievances include the outsourcing of some jobs and the capping of pensions.
It has been nearly a year since the stock market hit record highs, and since then, the indices have made little progress, enduring wild swings, as you all know, along the way. But can the bull market resume after a 12-month break? Mike Santoli takes a look.
It was a lost year for Wall Street. This week marks the first anniversary of the stock market's all-time high, and it follows a year of treading water with a couple of scary plunges along the way. The S&P 500 index is now about 3% below its May 21st, 2015 record high of 2130. Given the circumstances, it could have been a good deal worse. Corporate profits have declined for 3 straight quarters and are running about 7% below forecasts from the time stocks peaked. Most foreign markets suffered declines of at least 20% at some point in the last year. The U.S. economy has been too sluggish for the Federal Reserve to follow its plan to lift interest rates to more normal levels. And the race for president has followed a surprising path and now revolves around the theme of economic unease. So what then has been supporting stocks? Well, in part, it is those low interest rates. The 10-year Treasury yield has slid below 1.8% from 2.2% a year ago. Investors craving income have been feasting on dividend-rich stocks. This has driven the Dow Jones Utility Average up about 13% in the past year, the same amount that the Dow Transportation Index has dropped due to worries over sluggish global trade. This sort of rotation among sectors has allowed the major indexes to hover unusually close to their old highs without matching them. It has also kept stocks from getting much cheaper, though, as corporate profits have stalled. The S&P 500 trades just under 17 times expected earnings for the coming year. That's just slightly below its valuation of a year ago. Of course, if today's profit projections are a bit more plausible than the over-optimistic forecast of a year ago, stocks could certainly muster a run at those old highs. In other words, it will likely take a better economy and revived business activity to energize this meandering market. Unfortunately, it will likely be months before we'll know with any confidence if this is a good bet. For Nightly Business Report, I'm Mike Santoli at the New York Stock Exchange.
So can this bull market continue higher after that basic 12-month hiatus? Matt Maley is equity strategist with Miller Tabak, and he joins us now. Matt, good to have you with us. You know, a year ago when the market was at or hanging around those all-time highs, people didn't use the phrase overvalued. Now the market is a little bit lower, and everybody's worried about its being overvalued. That doesn't sound to me like a recipe to propel stocks higher.
No, Tyler, and the main reason for that, of course, is that earnings have been coming down. When you have valuations, you have price-earnings ratio. When the earnings are going down, that means the ratio is going to move up, even though prices are coming down. So that's going to be when you have valuations at these levels, combined with this sideways move in the market for 18 months, as you guys talked about, at a time when we still have all sorts of stimulus from the ECB and the BOJ, even though the Fed has pulled back, people are starting to get a little less confident about the effect or impact of central bank stimulus. So you got a lot of things working kind of against the market going higher, even though it hasn't been able to break down.
You know, Matt, though, a lot of people think as though we've seen the worst in terms of earnings, that we've troughed, if you will, and that if indeed that is the case, this might be a good time to put your little toe into the market if you have a longer-term time horizon.
That's certainly true. One of the concerns, of course, though, is that we have, the economy. The economy is still, we're still on the worst recovery since World War II. So how much is the economy really going to bounce back? And we see, a slower economy around the world. I mean, China seems to be stabilizing, but we're still getting a lot of mixed signals there. So it's not like it's bouncing back in a major way. However, if you're right, Susan, that's going to be very positive, because this whole thing with the bounce in oil is very important, because the real reason we had a big sell-off in the first quarter was because of stresses in the credit markets. Everybody was worried about a seizing up, like maybe not to the degree we saw in 2008, but still a seizing up. Since that hasn't happened and oil has stayed elevated, if we can get earnings to come up underneath, that would be very positive for the market.
Matt, thank you so much for your time tonight. We appreciate it. Matt Maley with Miller Tabak.
And still ahead, the biggest change to hit startup investing in years, and it could revolutionize how small businesses are financed.
The Supreme Court avoided issuing a major ruling on a case related to the Affordable Care Act. The challenge was brought by religious employers who objected to the health law's contraception coverage mandate. The justices said they would not decide the case and sent it back down to the lower courts.
There are new rules today for small investors. The Securities and Exchange Commission now permits Main Street investors to start putting money into startups, allowing them to get in on the so-called ground floor, something that only wealthier or accredited investors used to be able to do. But with this new opportunity also comes some risk. Kate Rogers has the details for us. Good to see you, Kate, as always. So who exactly are we talking about? Who can invest?
Hi, Sue. Well, the good news is that you don't have to be rich anymore to get in on an early stage investment in a startup. So individuals who now make less than $100K can invest either $2,000 or the lesser of 5% of their annual income or net worth. People who make more money can invest more. And until now, under Title II regulations of the 2012 Jobs Act, startup investors had to be accredited, meaning they had an annual salary of at least $200,000 or more, or a net worth of at least $1 million.
Kate, what can they buy? What can they invest in? Are there restrictions?
Well, Tyler, these are really early stage ventures, which are often very risky. So the funding cap for equity crowdfunding is at $1 million in a 12-month period. That's less than the average seed round was for small businesses in 2016, which is around $2 million, according to Crowdfunder. And once again, these aren't high-flying startups like Uber or Lyft. And the SEC and FINRA, they're warning investors that they really have to do their due diligence before deciding to back these small businesses because they could potentially lose their investment.
Right. That's the risk that you laid out so beautifully. But how do they physically do it? How do they invest?
So the SEC and FINRA have registered and approved several portals and registered broker-dealers to connect investors to company. So as of Friday, the SEC had registered 8 portals. We're still waiting for them to release the full list of names there. And also, guys, important to remember, bad actor rules are in place to protect investors. And FINRA and the SEC, once again, warning investors they really have to do their research before they're putting money into one of these ventures. You could lose the full investment. You might not be able to sell your shares for up to a year. And if you do see a return on an investment, it could be for as long as a decade until you actually start seeing that ROI come in. So it's definitely risky.
All right, Kate, thanks so much. Kate Rogers.
All right, Gannett Publishing increases its takeover offer for Tribune. And that is where we begin tonight's market focus. The owner of USA Today upped its all-cash bid by 22% to about $475 million. The news comes after the owner of the Chicago Tribune and the Los Angeles Times previously rejected Gannett's unsolicited offer and even went so far as to adopt what's known as a poison pill defense. The company has acknowledged the new offer and now says we're going to go ahead and review it. Shares of Gannett up 2% to $15.98. Tribune up fractionally to $39. Berkshire Hathaway's CEO Warren Buffett has offered financial support to a group bidding for Yahoo's internet assets. Dan Gilbert, the CEO of the online lender Quicken Loans, is among the group of potential investors. In addition, Buffett will only provide financial resources if the deal takes place. Yahoo shares did rise more than 2.5% on the session. They finished at $37.48.
Natural gas producer Range Resources will acquire rival Memorial Resource Development in a deal valued at $3.3 billion. Range Resources will also assume more than $1 billion of Memorial's debt. Shares of Range Resources finishing today down 10% to $37.69. Memorial Resource shares were up 3% to $13.86. And through a new rebate program, Valiant Pharmaceuticals plans to provide hospitals with steeper discounts on 2 of its heart drugs. The pharmaceuticals giant, which has been criticized for its past drug price increases, will offer rebates between 10 and 40%. That amount will be determined based on the volume of drugs purchased during a quarter. Shares of Valiant rose more than 4% today to $27.05.
Well, from coffee to baby food, Amazon now reportedly ready to disrupt another part of the retail business. According to the Wall Street Journal, the online retailer is getting ready now to enter the multi-billion-dollar private label market for groceries and other goods. But as Josh Lipton reports, the move may not be a simple one.
Costco has Kirkland, Walmart has Great Value, and now Amazon will have Happy Belly and Wickedly Prime, making it the latest retailer to expand its private label products. For one, this will allow the online retailer to offer consumers that many more products to choose from when shopping on its website. But there's also a strategic component. Amazon's CEO Jeff Bezos, with this decision, is going right after big-name competitors like Walmart, Costco, and Kroger. And by selling his own private label goods, Bezos can also put pressure on third-party merchants selling products on his platform.
It keeps these third-party merchants honest in, one, the quality of what they sell on Amazon, and in two, in the prices they charge consumers.
There's also a financial component to this move. Scully says that these niche products usually carry higher profit margins than name brands, and consumers are big fans. Store brand sales reached $118 billion last year. That was an all-time record and an increase of more than $2 billion over the previous year. There are risks for Amazon, however. The company has stumbled in the past in this area. For example, last year, Amazon made news when it had to pull its private label diaper brand, citing the need for design improvements. Still, analysts think Bezos is making the right move here, in part because the program will initially target and serve members of Amazon's $99 per year Prime program. It's important to keep those members very happy. Scully estimates there are some 60 million Prime members who spend up to 4 times more than non-Prime members. For its part, Amazon declined to comment on this report. For Nightly Business Report, I'm Josh Lipton in San Francisco.
Amazon's move comes as traditional retailers struggle to grow their sales and increase their foot traffic. But as we've been reporting, consumers are still spending. They're just spending in different ways. So it's no surprise that some startups are trying to take advantage of the shift in consumer behavior and beat traditional retailers at their own game. Courtney Reagan reports from Stockton, California.
While clothing sales at department stores and specialty retailers are less than stellar, growth at startups like Le Tote, Poshmark, and Tradesy indicate that shoppers are still buying clothes. Le Tote founder Rakesh Tandon set out to solve a daily issue, and it turned into a business.
Seeing the problem in my wife's life of a closet full of clothes, nothing to wear every day, was what really inspired me to think about a solution.
Le Tote is like Netflix for clothing. For $59 a month, Le Tote subscribers rent 3 garments and 3 accessories at a time. While the average subscriber rents 3 boxes a month, saving $600 over retail pricing, it's curating individual style that's key to keeping shoppers subscribed.
Le Tote is just one example of a retail startup that's using technology to disrupt the traditional way of thinking. In fact, over time, the founders realized that data was doing a better job of curating style selections than human stylists.
The startup isn't profitable yet, but subscriber numbers are growing 15% each month. And it's not without competition. Rent the Runway and the Black Tux rent formal wear and already have a loyal following. And then there's online consignment marketplaces like Poshmark, also getting venture capital funding to disrupt retail as we know it.
Traditional retail relies on the salespeople to make that final sale, relies on a lot of expensive advertising on TV and the print media to get users to associate the brand with the product. We think that mobile commerce, coupled with interesting social content and community, is the winning formula to build a business in this category worldwide.
But peers like Poshmark don't scare Le Tote. The co-founder has his eye on bigger fish.
A lot of traditional retailers will likely let players like us continue to do what we're doing. So we're not going to see much competition from them until, we start to eat their lunch in a bigger way.
A battle cry department and specialty stores may not want to ignore. For Nightly Business Report, I'm Courtney Reagan in Stockton, California.
Coming up, are online degrees really worth it? What potential employers think of your internet-based diploma?
And here's a look at what to watch for tomorrow. Housing starts are out and consumer prices are among the economic reports that will be released tomorrow. Also, Dow Component Home Depot is out with its earnings, and Amazon hosts its shareholder meeting. And that's what to watch for on Tuesday.
Well, it is commencement season. Many college graduates now entering the workforce. A growing number aren't graduating from a traditional college or university. Instead, they're earning their degrees online. But how are those diplomas viewed by potential employers? Sharon Epperson takes a look at whether all degrees are created equal.
"32-year-old Jonathan Paul took a swing at another route to a college degree after dropping out 9 years ago.
I kind of was in limbo here for a while, and I was looking for a way to complete my degree.
But he didn't go back to a physical campus to get it. He recently earned a bachelor's degree in finance from Penn State University after completing all of his coursework online at Penn State World Campus.
This time around, I've kind of approached it from more of a learning point of view instead of the end result of just getting a grade.
Nearly 3 million college students are taking courses exclusively online. bypassing the traditional campus experience. While they may not have the same opportunities to socialize and network as students on campus, they are gaining valuable skills.
Our students tell us that they come away learning more than perhaps they learned in a residential class. And as an added benefit, they also got more comfortable using technology along the way, which is a great skill to have in the marketplace today.
Online degrees are becoming increasingly more accepted by the academic community and employers. 71% of college leaders in one study said the outcomes in online-only education are the same or superior to face-to-face instruction. Another survey found nearly half of middle and senior managers, 47%, said they would be extremely or very likely to hire someone with an online degree.
Employers today are absolutely placing an online degree on the same level playing field with a more traditional university. However, with anything on your resume, you need to be prepared to speak to the benefits of your online degree.
Highlighting your creative thinking and ability to work in a group are key attributes to many employers. So is expertise in using social and digital media.
A lot of team meetings are being conducted via Google Hangouts or WebEx.
Online learners must be self-directed and good at multitasking too.
A big misperception, I think, is that online learning, you just kind of go at your own pace and you just knock it out in a week or something like that. But it's organized within each week.
For Jonathan Paul, creating a timeline to complete projects has paid off.
I have a 4.0 technically after, going back, and I think that demonstrates the commitment I've made and that I've been able to implement a plan.
Another attribute this recent grad hopes will catch the attention of potential employers. For Nightly Business Report, I'm Sharon Epperson in Center Valley, Pennsylvania. And on that note, that is Nightly Business Report for tonight. I'm Sue Herrera. Thanks so much for joining us.
And I'm Tyler Matheson. Thanks again to our friends here at WTTW in Chicago. Love Chicago.
Love Chicago.
Love Chicago.
It's our
Especially
kind
on a
of
nice
town.
spring day. Have a great evening, everybody. We'll see you tomorrow.